Welcome to the a16z podcast. I'm Michael Copeland. Venture capitalists have investors too, and they are known as limited partners or LPs. Unlike most investors, they have incredibly long time horizons, investing funds on behalf of foundations and universities and the like with a view that looks generations down the road. We've cajoled some of the firm's own LPs to join us on this segment of the pod and help us get a sense of how they view markets, valuations, and broader macroeconomic issues. Joining us are Andy Sparky Golden from Princeton, Ben Gomez from Pilot House Associates, and Edwin Poston and Mel Williams from TrueBridge Capital. Let's start at the beginning, and this is an odd question for somebody from a venture capital firm to be asking, but in your view of the world and your sort of how you look at a portfolio theory, why venture capital? I mean, over the last 30 years on average, returns have been great. So how does venture capital play a part in your portfolio? And really, why is it worth the sort of effort? Andy, let's start with you.
Sure. Well, first of all, I don't think we would buy an index of venture capital. So it doesn't matter that much that returns for the whole group hasn't been
So average is
great.
meaningless. Okay.
Right. But it makes so much sense for us. The way we think about things is less from a investment portfolio theory kind of approach, and just saying what's our basic set of objectives as an investor. Where do we have advantages, whether they're natural or acquired? And venture fits very well with those. So we've got Goldilocks size of assets. It means that these small investments can move the needle. We've got a very long horizon where we're investing not just for current generations, but for future generations,
Right.
Perpetual horizon. And we've got an asset size that I mentioned that this can move the needle, but also can support the effort that it takes to find the best folks out there. And frankly, we have access to those people. And so, venture is really about partnering with the very, very best. And we have some unfair advantages in doing that. So venture is actually about 10% of our portfolio right now.
Oh, interesting.
Yeah.
Ben.
I agree with a couple of things Andy said. I think that one of the key advantages that we have is a permanent pool of capital. And permanent pools of capital should do well investing in venture capital. One of the problems, however, is that if you invest in venture capital in general, you will have not done very well over the past 10 to 20 years. The reality of it is that there's a handful of firms that have done extraordinarily well in venture capital. And we've been fortunate to get access to those firms, and I think you can do very, very well combining permanent capital with access to those terrific firms. If you don't do those two things, though, I think you can do really poorly in venture. And I don't think it should play a role in most people's portfolios.
It's certainly the belief at the firm here that a disproportionate amount of the winnings go to a small number of companies and a small number of firms, for that matter. So I guess we're in sync with you guys there. You say perpetual, eternal, these time horizons that most of us can't wrap our heads around as investors. I kind of want to get at how that makes you think and behave differently. When you, again, are investing for generation after generation, what do you do that other investors might not?
We talk about the importance of thinking beyond the long term. So what we're trying to really focus on is establishing a roster of relationships that can endure and we're not too worried about the whole cycles. We're not trying to outguess those cycles. We talk about it's much more important to think about the who than the when of investing. Mm-hmm. And in fact, the who maybe even matters more than what they actually are doing. So our job is to put together a roster of 75 great firms all around the world in all different asset categories. That's not just venture, that's everything we do. And I think that attitude of just trying to build this perpetual virtual investment firm is a key difference.
But Michael, I think structurally speaking, when you do have a permanent pool of capital like a foundation or an endowment, you are able to bear a higher level of illiquidity than other investors might be able to bear, and you're rewarded for bearing that illiquidity in an asset class like venture capital.
Right.
Whereas, as Andy said, if you can choose well and you can pick the right managers who are going to outperform, you can really enhance the overall rate of return for your portfolio through picking well and bearing that illiquidity and receiving an illiquidity premium.
So does that mean, and Edwin, I'll put this to you, that you guys remain untouched by cycles? I mean, you try and sort of, zen your way through them, or how does that work?
It's a great question, and I absolutely agree with Ben and Andy. It's very hard to ever pick when is a good time to invest in any asset class, but venture in particular. The capital we commit today will actually be put to work 2, 3, 4 years from now, so it's hard to say what the world will look like. The data suggests is if you invest with the best managers over time, you're handsomely rewarded in venture. And we absolutely believe that's the case now and has been the case in the past. We suspect it'll be true in the future. We think there's a secular bull market in technology. There'll be valuation blips along the way. But if you invest with very talented managers, they'll capture that over time. Sometimes will be better than others, but data suggests if you invest with the best managers, I think all but really one vintage year have you not been handsomely rewarded with a nice premium to public markets.
So it is the who, like you were saying, Andy. So cycles, they're like, Teflon to you. You don't care.
Well,
or the GDP for that matter, or interest rates.
They should be. We should be immune from cycles, but the reality is human nature kicks in, and everybody says they have permanent capital, and all of our organizations have permanent capital. But inevitably, people buy at the wrong time and sell at the wrong time because of the pressure put forth by market changes. I mean, I go to the gym this morning and CNBC's blasting there, talking about yesterday's stock price moves and why they moved.
Right.
It's largely irrelevant to us, but human nature is such that we pay attention to that.
I want to get back to this idea of perpetual or eternal capital and the who. I mean, is there any way for regular investors or individuals to take some of that kind of approach and apply it?
Well, they can, but I'd put it a little bit differently. They can take that approach of saying, what are we trying to achieve? What are we really like? What are our strengths? What are our weaknesses? And they can apply that framework to come up with the right answer for them. But the right answer for an individual, unless the individual has institutional size and net worth,
right?
And even then, is that answer is going to be different from an institution like Princeton.
Right.
And so, we're always trying to just start from those first principles about what makes sense for us on average over the long term, and then maybe do some tweaking around that. But clearly, Princeton should be invested quite differently from my 87-year-old mother.
Right. Well, I know you guys say that cycles kind of don't matter in some sense, but I want to talk about cycles and technology. We've talked about unicorns today. What are you guys seeing, and how does it compare to, past cycles or phases that we've been through in the technology world? And how do you view what's going on?
I'll start that one with the structural of the venture industry. 20, 25 years ago, there were always 20, 25 firms that mattered. And now it seems like there's somewhat of a consolidation of power. That number is consolidated to a fewer number than that. Some say 5 or 6 really drive the industry, and we think there's a lot of truth in that. But there's also a lot of seed managers, guys who are investing pools less than $100 million that are also contributing to the innovation cycle that seem to be a nice place to be able to invest capital.
So more seed money, you're putting more money into seed because there's more funds.
It's still a de minimis amount of our portfolio, still 10, 15%, but we are putting capital there.
What about this this phenomenon where private companies are saying private longer, which is to say that liquidity events are not happening in the way that they were before? Again, I know you have a different time horizon, but within the funds that you're invested, you want liquidity at some point, I would imagine. So how do you see that playing out? Does the IPO window have to open up? Does, sort of at the top end, more money come in to then provide liquidity in private markets? Any sense of how that might play out?
Well, we've seen disconnects happen in the past, and you're seeing one happen now. I happen to think it's largely irrelevant. Clearly, companies are being rewarded in the private market, so they don't have to go public. At some point, public markets will shift and private markets will shift, and that will turn around. I think to us, to endowments like ours, it should be largely irrelevant. Mm-hmm. Sure, it's nicer to get liquidity a little bit quicker, but what's going on now will change.
I think as long as there continues to be an interest in the tech sector and an interest in the companies that are being financed privately and demand for those companies, then whether we as investors achieve liquidity in the public markets or in the private markets is a little less relevant.
Right.
I think it will happen as long as there is demand for technology and those companies.
Andy, I saw you nodding your head.
Yeah, I think, again, we all saw the data earlier today about some of the differences between this snapshot right now and the U.S. snapshot over the past time in terms of the ratio of private versus public funding. I think, you look cross-sectionally around the world, and there's been kind of just different patterns. We kind of grow up assuming that there's a certain balance between public and private companies, but it's very different in Germany than it is in the U.S.
Right.
And so I think the current ratio maybe can work, but it's going to have to be sensible and consistent with just a lot of other things that are going on in the broader investment landscape. So, to maybe give the first kind of downer of this conversation, there's this idea that very sensible explanation for why the T. Rowe prices are investing at these levels. That is a very good explanation for why it's happening, but it doesn't fully explain should it be happening, and if the answer is maybe not, then maybe that can't continue.
I see.
That, we're talking about the value when the IPOs do happen, maybe it won't go up as much. But what happens if it goes down? That's going to start flowing back through, the valuation chain. And I think that's where you will begin to see, the cracks, of what may be, very broadly speaking, a generally slightly overvalued to maybe more than slightly overvalued venture market.
And is it because some of this money that's come into the private markets tends not to stick around? It's not like you say, it's maybe not what they should be doing. It's not natural to them to sort of play in this part of the market. Things happen and they don't necessarily stick around.
It's not consistent with what they're selling to their own customers.
They'll be much faster to exit if things go south.
Right. You mentioned sort of the global economies and how private and public market ratios kind of play differently. Are you guys also thinking about different regions in a different way than you have in the past? And how is your focus shifting, if it is indeed at all?
I'll speak for myself. We don't think about where, we think about the who that Andy said. And we like to invest with managers that have broad mandates and can invest anywhere. Mm-hmm. And frankly, we take our lead from wherever they think the best global opportunities are.
Focusing just on venture, I think 10, 12, 15 years ago, there's a lot of hope for what we'd see taking place in India and China and maybe even in Europe.
Right.
And I think the business innovation has taken place. Maybe the technology hasn't manifested itself as much as we might have thought 10 or 12 years ago. We personally invest just in the U.S., India, and China. And India and China is a smaller part of our business than it used to be 5 or 7 years ago. We absolutely look in Europe. But it's our best belief that the number 1, number 2, number 3 best venture manager is not as good as the 7th, 8th, or 9th best opportunity in the U.S. Right. So we're staying really focused on Northern California early stage.
The sort of global ambition ended badly for a lot of venture firms kind of the last time out. I mean, are there things that have changed structurally and on a macro level that make it seem more wise this time around?
I'll start with the Nobel laureate economist Robert Shiller recently came out with his 2 cents saying that everything right now is expensive. There's not a whole lot of assets that are cheap.
Talk about downers. He's usually a downer.
Yeah, he is a downer. Yeah. But I think the takeaway is there's not a lot of places to hide per se. So if you get liquidity from your venture capitalist, it's not as if there are a lot of places you want to go invest it otherwise. Mm-hmm. So I think that's a structural change from what we've seen 15 years ago.
Right.
I do think that on a global basis, there has been a pretty significant change in the past 10 or 15 years. You had 3, 4, 5 major technology centers in the U.S., obviously led by Silicon Valley. And I think Silicon Valley has just outdistanced all of those by a lot in the past 10 or 15 years. And frankly, the number 2 technology center in the world that we see is Israel. And we think the rise of Israel as a venture market is something that's very profound, and obviously there's a lot of Israeli technology embedded globally, so we see a lot of opportunity.
We talk about there were 50 million PCs back in the 80s, right? So that was your market. Now with mobile, your market is several billion. But do you see a structural change that makes the opportunity different today in technology, and do you view it differently? Or, we certainly do. I'm just wondering if to reality check that with the way you guys view the world.
Look, I think this probably is the most exciting time. However, there's this issue, and we heard some of it this morning. This issue about, it's exciting because so much can happen and so much can happen cheaply. But, capitalism kind of has this issue that if it's cheap for me to do it, and it's also cheap for Ben to do it, maybe only one of us is going to win. Maybe being second in that case is kind of okay. But, if there's 1,000 people competing, that makes it a lot harder to as a company to win. And I think that's, as a company, then you really have to be thinking even more about who your partners are and how they can help you differentiate yourself from those other 999.
Those are good points. We definitely think there are some secular trends that are increasing the rate of innovation today. The rate of innovation has always increased at a fairly steady pace over a long period of time. If you look at the number of patent filings, it's always increased, 3% a year, et cetera. But if you look at the tailwinds today in terms of, low-cost semiconductors, a movement to the cloud and cloud infrastructure, the increase of mobile penetration around the world, there are just some very large secular tailwinds that are increasing the rate of innovation and increasing opportunities for technology companies to be built at a very large scale and for opportunities for all of us in the room here.
I think one of the interesting things about getting outside of Silicon Valley is not being in Silicon Valley, quite frankly. And so you guys are all coming from outside Silicon Valley. I wonder if there are things that you feel like, oh God, here they go again, or that you would advise us on, given, again, the fact that you're not sort of in this tunnel vision of Silicon Valley like we tend to be.
I think I might almost take an opposite point of view. When we travel and you get off the plane and there's no Uber, you realize what a massive market there is left.
Right.
Or folks who never heard of Airbnb. The market is still absolutely massive. So I think working here so often and seeing what's taking place and realizing how much hasn't been adopted, I think gives us more enthusiasm that there's lots of room for growth.
I agree with Edwin. I think there will be some massive companies that are being formed now that will be built that will dominate their industries. But I do think, having been in this industry for a long period of time, there are some trends that we're seeing now that are troublesome. We're certainly seeing multiples expand in the private markets, whether it's multiple to revenue or multiple to, forward revenue. We're seeing multiple expansion. We're seeing, time to make a decision decrease, and those are certainly, some worrisome signs and some signals that we're keeping an eye on.
Right, Andy. But again, you guys have seen this all before.
Yeah, there's one kind of fundamental issue that I worry about that folks here are not worrying enough about, and it's not surprising where it comes. It's again what happens when you go from what makes sense for one thing and then getting generalized to everyone doing it. So when people talk about potential markets and they talk about, well, here's the number of people, and if they all buy this, they're going to spend that, and we can capture that. Those same individuals are also needing to buy other things,
right?
And they can only spend 100% of their wallet, right? And so,
right.
It's when these different silos are looking, saying, oh, well, we can capture that. At some point, they're actually going to be competing not against themselves, but they're going to be competing about the other needs and wants that the consumers have, or even that the corporations have. So I think there's a possibility that they overestimate
So
the total.
Like Silicon Valley, you need
market.
sort of 300% wallet to go around for everyone to achieve what they're saying they're going to achieve.
But it's interesting. That's an interesting point, and I would love your reaction to this. But it seems like in this cycle, there's a lot more disruptive ideas and technology that are disrupting incumbents and. Not necessarily creating new markets where I'm trying to take wallet share for a new idea or new product, but simply displacing a company spend or an individual spend from one provider to another provider. I see more of that as things move to the cloud, as we have mobile computing. I see more new technologies disrupting established industries as opposed to creating entirely new industries.
Well, the clear examples of that are, you wouldn't have thought of technology disrupting transportation or lodging.
Right.
And, huge companies are being created.
So Uber, for example, I'm not necessarily, Uber will take more share of a wallet than someone would otherwise spend on a taxi. But the majority of his business is just shifting it from one provider to themselves.
I think that's true. I think, nonetheless, when you sum up everything, it may not be that they're creating or they're meeting some new need. Right. When you sum up everything, so go to the enterprise side. Well, look, security is really important, right? But every dollar that the company's spending on security is a dollar that they're spending less on somewhere else. And yeah, security is not a new idea, not a new need. But you look at all these meetings that we all go to, and you hear these great things, and you think, well,
they can't buy it all.
The end users cannot buy it all, and I think we're pretty far away from that being the binding constraint. I'm not trying to rain on anyone's parade in the here and now, but I think that can get lost in this very siloed look.
Well, Andy, Ben, Edwin, Mel, limited partners, your thoughts are certainly not limited, so I would call you unlimited partners in some sense. Thank you guys so much for taking your time, and hopefully we'll be talking soon.
Thanks, Michael.
Thank you for having us.
Thanks.